Right now, there is over 1.3 trillion locked inside the financial system, not in cash, not sitting safely on the sidelines, but trapped inside leverage positions, margin accounts, borrowed money. And here's the part nobody is saying out loud: that money is not stable. It's not patient. It's not long-term. It's temporary. And when it moves, it doesn't move slowly. It moves all at once. Now look at what's happening at the exact same time. Silver is trading around $80 an ounce. That's already a massive move from where it was just a few years ago near 20-25. But here's the strange part: even at these levels, even after this rally, almost nobody in the US is paying attention. Because if you open a trading app right now, you'll see a number. At 80, at 81.79, up a little, down a little. Nothing dramatic, nothing urgent, nothing that screams system level shift. But underneath that number, something has already changed, not gradually, not slowly, structurally. Because while retail investors are staring at pricey, the actual silver market is becoming dangerously thin. Let me explain what I mean. There's a metric called COMEX open interest. This tells you how many active contracts exist in the futures market. In simple terms, it shows how much Wall Street participation is in silver. Now here's the problem. That number has been falling hard. From well over 180,000 contracts down toward roughly 110,000 to 120,000 range. That's a collapse in participation. A market that used to be crowded is now almost empty. And normally, when participation drops, price drops with it. Less demand, less speculation, less momentum. But that's not what's happening. Silver is holding strength, even rising, while participation is collapsing. And that should stop you right there, because that only happens in one situation: when paper traders leave, but real buyers stay. This is the first signal. And almost nobody is talking about it. Now here's where things get more serious. Let's go back to that 1.3 trillion number. That figure comes from US margin debt. This is money investors borrow to buy stocks. It's leverage. It's fuel for bull markets. And historically, it always peaks right before something breaks. Before the dot-com crash in 2007, before the financial crisis, margin debt hit extremes and then reversed violently. Today, we are not just at extreme levels, we are at record levels, over 1.3 trillion. Let that sink in. This is not normal market behavior. This is a system running on borrowed momentum. And here's how margin actually works. When markets go up, D, investors borrow more, B, prices go higher. But when markets drop, E, margin calls trigger, G, forced selling begins, and that's where everything changes. Because when margin calls hit, investors don't choose what to sell. They sell whatever they can. Stocks, ETFs, crypto, gold, silver. Everything becomes liquidity. So the first phase of a margin unwind, it looks like everything crashing together. But here's where silver becomes different. Because unlike stocks, unlike bonds, unlike most assets, silver is tiny. The entire silver market is extremely small compared to global capital. And even more important, the tradable float is even smaller. So when capital rotates, it doesn't take much to move price. Now combine that with what we just discussed: open interest collapsing, speculators leaving, physical demand holding. What you're left with is a market that has less liquidity, less resistance, less sellers. That is not a weak market. That is a market that's being cleared out. And cleared out markets don't drift higher. They don't move slowly. They gap. They jump. They move in ways that feel out of control. Now here's where it gets even more interesting. Because the buying that's replacing Wall Street is not coming from where most people think. It's not coming from hedge funds. It's not coming from US retail. It's coming from Asia. And you can actually see this in the price behavior. Silver tends to firm up during Asian trading hours and go quiet during US hours. That's not random. That's flow. It means the price discovery is shifting away from New York, away from COMEX, toward Shanghai, Singapore, Hong Kong. And that matters more than most people realize, because the Western system is mostly paper-based. Futures, ETFs, derivatives. But the Eastern system? It's physical. When buyers in Asia step in, they don't want exposure. They want metal. And that changes everything, because physical demand doesn't disappear overnight. It doesn't panic sell. It doesn't react to headlines. It accumulates quietly, consistently, relentlessly. So now you have two forces building at the same time. On one side, a 1.3 trillion leverage system that can unwind violently. On the other, a tightening physical silver market with fewer sellers. That's not a normal setup. That's a pressure system. And pressure systems don't stay stable. They release. Now let me ask you something. What happens when a massive amount of capital suddenly needs a place to go in a market that has very little liquidity? It doesn't flow smoothly. It overwhelms the system. That's how moves become exponential. And this is exactly why silver is different from gold in this phase. Gold is larger, more liquid, more stable. Silver is smaller, thinner, faster. It reacts harder, moves quicker, and overshoots more aggressively. That's why in previous cycles, silver didn't just follow gold, it outperformed it. Now here's the part most people miss completely. The trigger for the next move in silver is not silver itself. It's the system around it: margin depth, liquidity stress, dollar weakness. Institutional repositioning silver is just the endpoint. And when all those forces align, price doesn't gradually adjust, it reprices. Now, before we go deeper into this, quick pause. If you're starting to see how different this setup is, this is exactly why you need to be paying attention right now. Because by the time this becomes obvious, the move is already gone. Now let's go deeper, because this is where the story actually changes. Up to this point, we've talked about what's happening margin debt at extreme levels. Silver market thinning out, physical demand quietly replacing speculation. But now we need to answer a more important question: who is actually buying? Because once you understand who is on the other side of this market, you understand where price is going next. Let's start with what's not happening. US. Retail investors are not driving this move. You can see it in ETF flows, you can see it in trading volume, you can see it in sentiment. Most investors are still focused on stocks, AI tech, short-term trade, silver, still considered boring, still considered slow, still considered secondary. But here's the reality. The biggest moves in markets don't start with retail. They start with institutions positioning quietly. Now look at the global picture. Central banks around the world have been accumulating hard assets aggressively over the last few years. Mostly gold, yes. But silver benefits from the same macro forces: a currency debasement, dollar uncertainty, a trade fragmentation, commodity revaluation. And here's the key difference: is silver is not just monetary. It's industrial, which means it's being pulled from two directions at once. One, monetary demand, wealth protection. Two, industrial demand, real world usage. And right now, both are increasing. Think about what's happening globally: energy transition, solar demand rising, electrification, silver usage increasing, defense spending, electronics demand rising, AI infrastructure, data center expansion. Every one of these requires silver. Not optional, not replaceable easily, required. And supply not responding fast enough, because most silver is mined as a byproduct of other metals like copper and zinc. So even if silver demand spikes, production doesn't instantly follow. That creates something extremely important: a structural supply constraint. Now combine that with what we discussed earlier: a less speculative supply, open interest falling, with more physical demand, a limited ability to increase production. This is how markets quietly move into deficit conditions. And deficit markets don't stay stable, they eventually reprice. Now let's bring in the next piece, the Federal Reserve, because no conversation about silver is complete without understanding the Fed's position. Right now, the Fed is trapped, and not in a theoretical way. In a real mechanical sense. Here's the situation: inflation has not fully disappeared. Growth is slowing, debt levels are extremely high. So the Fed has three options: 1, raise rates; 2, cut rates; 3, do nothing. Each one creates a problem. If they raise rates, they risk breaking the economy. Debt servicing costs explode. Markets react negatively. If they cut rates, the dollar weakens. Inflation risks return. Commodities surge. If they do nothing, liquidity tightens. Financial stress builds. Something breaks anyway. There is no clean path. And markets are starting to realize that. Now connect this to silver. Silver doesn't move just because of supply and demand. It moves when confidence in the system changes. When trust in a currency, a policy, a stability starts to weaken. And that's exactly the environment we're entering. Now let's talk about the real trigger, because this is where everything accelerates. Most people think silver moves because of Fed meetings, headlines, but those are surface level triggers. The real trigger is liquidity stress. When something in the system forces capital to move quickly, that could be a sharp equity correction, a credit market event, a sudden spike in yields, a funding squeeze. And when that happens, capital doesn't move based on preference. It moves based on necessity. First phase, everything sells. Second phase, money looks for safety. Third phase, it flows into assets that are liquid enough to absorb it, scarce enough to move, and that's where silver comes in. Because silver sits in a unique position. It's not as large as gold, so it moves faster. It's not as risky as equities, so it attracts defensive capital. And it's not as saturated as other trades, so positioning is still early. Now add one more layer. When margin unwinds and capital gets pulled out of the system, it doesn't disappear. It rotates. And historically, after the initial liquidation phase, that capital rotates into hard assets. Gold first, then silver. But because silver is smaller, it often moves more violently. Now let's tie everything together. You have record margin debt, unstable system, a falling open interest, fewer sellers, rising physical demand, stronger base, the Fed trapped Bay policy uncertainty, a structural deficits, tightening supply. That is not a normal market. That is a setup. And setups don't last forever. At some point, something forces the system to adjust. And when it does, price doesn't slowly drift higher. It jumps levels. This is where people get caught off guard because they're waiting for confirmation. They want clear trend, clear signal, clear headlines, but by the time those appear, the move has already happened. Now, I want you to think about this carefully. Silver is already around 80 range. That alone tells you something has changed, Because for years, silver struggled to hold above a 20 over 25 audio of even 30. Now it's holding multiples above that. That's not random. That's not temporary. That's repricing. And most people still think we're early in the same old cycle. We're not. We're in a different phase. A phase where paper influence is declining, physical demand is rising, system stress is building, and that combination doesn't produce slow markets. It produces explosive ones. Now here's the key takeaway. This isn't about chasing price. This isn't about guessing tops or bottoms. This is about recognizing when the structure of a market changes. Because once structure changes, price eventually follows. And by the time it becomes obvious, it's no longer an opportunity. It's already a move. So the real question isn't, will silver go higher? The real question is, will you recognize the shift before everyone else does? Because right now, the signals are there. Quiet, subtle, but very real. And if this analysis helped you see the market differently, make sure you're subscribed. Because what happens next in this cycle is not going to be subtle. It's going to be fast. And most people won't be ready for it